Hi everybody, this is a sample video tutorial for ACCA Belfast for the P6 Advanced Taxation course. We'll be including some of these tutorials for you to assist you with your studies. So to kick off, the area of concern here really is an employed individual, someone who's employed in a job and or has been for some time, and their employment is being terminated, and as you'd appreciate, that could be for a variety of different reasons. Now, in terms of the tax issue, really the key point to bear in mind here is that if the individual receives a payment or indeed several payments, what we need to know is how do we tax them in the income tax computation. There could be a variety of different payments. Some could be contractual, perhaps, as per the contract. Some could be non-contractual, perhaps ex gratia payments, and there could be statutory payments also. So really the essence of lump sum payments on termination and the tax of those payments is, what type of payment is it, and what category does that payment fall into? Do we tax it? Is it tax-free? Etc., etc. So that's the first thing to bear in mind. Numerous different payments and possibly taxable in different ways. In terms of how the examiner, Rory Fish, could come at this, he could come at it in a narrative sense, so a written question, or perhaps more likely in some sort of computational sense, possibly both. Okay, so key point is, how do we tax the payment that the individual has received, or indeed payments? So the legislation relating to lump sum payments is included within ITEPA. So that's the Income Tax Act 2003. Now you've no need to know the particular section number or indeed the Act for P6 purposes. And you may be wondering, looking at this screen, why Clint Eastwood has surfaced in some way. That'll be explained on the next slide. So the key thing is that is a core area within the Income Tax Act 2003, and it looks to me as if there's possibly three areas, possibly good, bad and ugly, in terms of the tax treatment. I think it's always helpful in your studies, whether it's P6 or otherwise, to try and maybe tag certain areas onto sort of analogies in some way. It may help you remember them. Certainly that's my experience of teaching this paper for several years. So, in terms of the income tax computation, we've said Clint Eastwood and good, bad and ugly has something to do with termination payments. Certainly Clint will have terminated several people in his time. So really, when we say good, we're talking about payments that are wholly exempt. As you'd expect from a taxpayer, if the amount is exempt, then it's not taxable. So that's pretty good. We're not going to include it in the income tax computation and tax it, and therefore increase the income tax payable. Second one here is partially exempt payments. In fact, there's a limit there of £30,000. So, in other words, what we're saying is there are some payments that up to the level of £30,000, they're exempt. So a payment perhaps of £40,000 in that area could be partially exempt up to the 30, and then any balance being wholly chargeable. So we've said that that's sort of bad in the sense that it could be taxable, but not so bad in the sense that we haven't got any sort of de minimis level. We've got £30,000, and certainly in my experience of dealing with clients over the last sort of 20-25 years in tax all over the UK, that in terms of the volume of payments, or indeed the absolute amount of payments, very irregularly do I come across payments in excess of that level. So if they're categorized within this group, then in effect we've got that 30k value to use up before they become taxable, and those are generally ex gratia payments. So just to recap then, we could have some payments that are just wholly exempt, and we'll touch on those in the next slide. We could have some payments that are in the second group, which is what we're calling partially exempt, so in effect exempt up to the value of £30,000, and then over that value they're going to be wholly taxed. We're saying they're bad, but maybe not the correct use of terminology, but pretty good up to 30, bad after that. Now the third group, as you'd expect, is wholly chargeable. So what we're saying is if you receive a payment that's categorized under that group, it's wholly chargeable. In other words, you put all of it into your income tax computation and tax it. And invariably within that group, we're talking about payments that are contractual, in other words, laid out or set out in the individual's contract of employment. And those payments will be what you would expect to be sort of customary or usual, expected. So those are the sorts of words you need to look out for in the questions, where you see a payment that is, contractual and it's the employer's usual practice or customary practice, then indeed that amount is going to be wholly chargeable and taxable. Okay, so in terms of the items that would go in each of these groups, looks like we've got 3 so far: good, bad, and ugly. In terms of the items that will go in, these are where the tricks come into play that I've mentioned in the how to pass video, which you may have watched. The idea here is that we've got particular types of payments. So for example, we've got let's say a payment in respect of injury or disability, in other words linked to injury or disability. That will be wholly exempt. In other words, we will not tax it in the income tax computation. And indeed, payments relevant to statutory redundancy will be wholly exempt. Okay, so you're sort of getting the drift now that we've got 3 categories and we're putting certain types of payments into each of those categories. So the sort of words that you need to look out for in the questions are really those words in red there. This was a statutory redundancy payment, this was a payment from an approved pension scheme, etc., etc. So the second group here, we've said that that's a partially exempt group. Now if you look slightly further down on the slide there in the middle, you'll see that yes, there's a 30k limit, a £30,000 limit for these types of payments. And as I've mentioned, invariably these payments are genuine ex gratia payments. In other words, payments made by the employer ex gratia. So they won't be contractual. They won't be laid out or set out within in the individual's contract of employment. So several payments there, normal redundancy payments, some pylons or payments in lieu of notice pylons, and perhaps damages as well. Okay, so the key word really within this second group is genuine ex gratia payments, non-contractual. Okay, now I've mentioned down at the bottom there you'll see a statutory redundancy trick. Now what I'm saying there is that in the first group we have a set of payments called statutory redundancy. So payments are made in line with legislation or tax legislation on statutory redundancy, generally based on year's service or a month's service. So the trick here is that if an individual has received a payment that is a statutory redundancy payment, what do? We know that that payment is wholly exempt. Okay, so it's not taxable. Now, the trick is this, that within the second group, if a statutory redundancy payment has been paid, then that statutory redundancy payment reduces the 30k limit. So let's say that it was £5,000. The limit within the second group then becomes £25,000, i.e. 30 less 5. Now that's the only time that the statutory redundancy limit of 30 is affected. So it's a little bit unusual because it's the second group, but it's affected by a payment within the first group, but only statutory redundancy. So watch out for that trick. That's played very, very regularly, not least within the P6 syllabus, but also all tax exams that you would do. Okay, so the third group is a group really that's ugly. We don't like this group at all, because any payment that falls under this category, for example, a payment that is defined as a restricted covenant, or perhaps a gardening leave payment, will be completely taxable all of it, no 30k, nothing exempt in any way, just so that you know a restrictive covenant is just basically some form of restriction placed on the individual who is exiting by the employer, that perhaps they can't work in a particular area or a particular field for a particular length of time. So again, you'll see within this this area of lump sum payments on termination that getting the terminology, or getting familiar with the terminology, it's all a little bit funny, isn't it? Particularly if you haven't sat a tax exam for some time, or maybe ever. The terminology is a little bit funny, but the more we see the terminology, and the more that we see how individual payments are treated within an income tax comp, the better we get. Okay, so the third group there, what we're calling the ugly group, are payments invariably that are contractual payments, and they are customary, usual, expected. Yeah, so we have three groups: good, bad, ugly. The first one we really like because the payments are good, they're wholly exempt. The second one we're calling bad, but there is a 30k limit there that we can go up to before anything becomes taxable. So really not too bad. And the third group really is the ugly group. Anything that falls under that category is going to be taxed in full. We don't really like that group. Very, very ugly. So contractual payments. You'll notice between the second and third group, we've got that thing going on where some payments are non-contractual, partially exempt, and within the wholly chargeable group, invariably they are contractual. So watch out for that as well. I've seen Rory Fish, the P6 examiner, examine this area, just really based on honing into whether or not the payment is contractual versus non-contractual. Okay, so in final points on this. How do the payments get treated? We talked about payments being taxable. Let's say the wholly chargeable payments, the gardening leave, for example. So what do we actually do? Well, the key point, and this is a practical point really for the employer, which impacts upon the employee, of course, is the practical point is whether or not the P45 has been issued. So if we have a payment that's being made, let's just say that is a wholly chargeable payment, it needs to be for this particular slide, we've got a situation where the payment would be paid net of PAYE in the ordinary sense, a little bit like normal salary, if the payment is made before leaving and the P45 is issued. In other words, the payment would simply be included within the pay slip, let's say coming up to the end of the month, and the individual would receive then the net amount after PAYE has been deducted. Do bear in mind, of course, here that primary national insurance contributions for the employee won't be relevant. So the first option here is that it goes through the PAYE system in the normal way, okay, if paid before the individual has left the employment. Okay. The second option is that if the individual payment is paid after the individual has left the employment. Now, in that scenario, in effect, the P45 will have been issued, so simply a deduction at the individual's marginal rate of tax, which could be 20, 40 or 50%, is made. Yeah. So there's two possible options there. You'll notice on the bottom right there I've said top slice, and what I mean by that is that when you're taxing the payment within the income tax computation, what you're doing is you're adding this taxable lump sum payment on top of all income. So when you become more familiar with how an income tax computation works, what you'll see is that invariably the last taxable amounts that are taxed are the dividends. And really this issue here, you don't need to understand it fully right now, but this issue here is really saying that where we have a redundancy payment, we tax it as the top slice of income to really preserve those dividend rates, to make sure that the individual is getting those preferential dividend rates, so we keep the redundancy payment at the top. Okay, really, in terms of sort of closure on this area, or a summary, three types of payment. We've said good, bad, and ugly. In effect, what we're saying is one set that is wholly exempt, one set that is partially exempt in the middle, and one set that is wholly chargeable. We've got this issue between the bad and the ugly, i.e. the second and the third group, as to what is contractual or ex gratia, second group, and what is non-contractual, third group, wholly chargeable. If you think about it, I think what the revenue are doing there is that suggesting that if these perks, as it were, are laid out in your contract of employment at the outset of your employment, then really, you're expecting them, and the revenue would quite like to tax you. But if it's just something that in the middle group that was just decided upon based on circumstance, in other words, the partially exempt group, then as far as the revenue are concerned, they're going to give you a 30k sort of window there to place the payments in on a tax-free basis. Okay, so watch out for that 30k limit. Also watch out for the statutory redundancy trick that I mentioned, i.e. the idea that it reduces the 30k limit within the second group. Just be careful with the P45 and the leaving situation. In other words, whether or not the payment is made before the individual leaves, and therefore just simply subject to the normal PAYE provisions without NI, or if it's made after the individual leaves, which will then necessitate a deduction at the individual's marginal rate, which could be 20, 40 or 50. And also watch out for the top slicing, i.e. the idea that the redundancy payment is placed on top of all other income within an income tax computation and really taxed last to preserve the dividend rates, which are obviously slightly different to the normal non-savings and savings rates. So hopefully that made sense to you. As I say, we'll be including some of these webcasts and tutorials within your course for ACCA Belfast. So we hope that you'll join us for your next sitting of P6 Advanced Taxation. And wherever you study, I hope that the video tutorial that I've just done is helpful to you. So thank you, and thanks for listening.